New Holdings stock has roughly doubled year to date in 2024. And of course, I'm happy about that as I've rated the stock as a buy all year long in 2024. The company recently reported a quarterly financial update, which I'm going to review with you in this video here. I'm going to highlight all of the big picture items, the items that I've been talking about with New Holdings for a couple of years now. Then I'm going to update my buy recommendation for New Holdings stock and let you know if I still think it's a buy, considering the new valuation and the new financial results that came out of the company's earnings update. So let's take a look at this interesting financial services company. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, New Holdings saying it added 5.2 million new customers during the quarter, marking a year-over-year increase of 21 million and reaching a total of 110 million customers, the management team said on November 13th, 2024. That helped the company's profitability jump to 553 million on the bottom line, up from 303 million in the same quarter last year. And of course, if you're increasing 5 million customers quarter over quarter, and you're increasing your net income by almost 100% year over year, your stock price is going to react positively, and New Holdings is no exception. New Holdings stock price is trading at $15.23 per share. That's up from around $8 per share where it started 2024. Of course, I've had New Holdings stock rated as a buy all year long, borderline buy to be precise. And I last updated that recommendation on October 3rd, 23rd, reiterating that buy recommendation. I'll update this rating by the end of this video and let you know if I still think it's a buy as of November 14th. Deposits increased by 60% year over year to $28.3 billion. And deposits are important for New Holdings because this is money the company can use to make loans. And when customers are depositing, that's usually a lower cost of capital than if New Holdings has to use investor capital to fund loans. Usually customers are willing to leave money in bank accounts at very low or near zero interest rates, and sometimes they just leave money in checking accounts that are earning 0% interest. And so that's free money for New Holdings. I shouldn't say free money. That's a very low cost of money for New Holdings, and then New Holdings can then take that money and then lend it out at a much higher interest rate, and then that spread is the profit. And that's what the company reported on here, risk-adjusted NIM. NIM stands for net interest margin, the difference between the cost of money and how much it earns when it lends money. It's kind of like a merchandiser, right? If you think of a merchandising company like Walmart, Walmart makes a profit by buying things from its suppliers and selling them to its customers at a higher price. New Holdings does a similar thing, but with money. It gets money from customers at a lower price and then lends it to other customers at a higher price. And that spread is its profit margin, the net interest margin. And that is expanding 10.1%, and that was up by 110 basis points from last year. So in other words, New Holdings is getting better at the core competency of the business. That's the core of this company. Getting money from customers, lending it out to other customers, and earning a spread on that. How good New Holdings is at achieving that task will determine how much shareholder returns it delivers. So if you compare the company's quarter over quarter active customers, you can see here from the second quarter to the third quarter that increase of over 4 million customers, 4.5 million to be precise. And if you compare year over year, 91.7 million active customers, up from 73.8 million in the same quarter last year. Equally as impressive, the monthly active cost to serve per customer decreased. So as they're getting more customers, the cost to serve these customers is decreasing down to 0.7 from 0.9. So you can see a solid improvement there of over 20% in cost to serve each person. And this is falling on the back of about a year ago, I would say a year and a half ago, New Holdings made the conscious decision to go after more profitable customers. and not just go after any customer. And a similar strategy has been undertaken with many financial services company, including StoneCo, which is another Latin American financial services company. And then more domestically, PayPal has tried this same strategy where they're going after more profitable customers. And it's all working really well for all three of the companies. And then it's good for the industry overall. It lifts industry profitability if each company focuses on the customers that they can serve most effectively. If everyone does that with discipline, industry-wide profitability will increase. No one will be going after someone else's turf, spending more money on incentives, promotions, staff, additional resources to attract those customers, and thereby hurting profitability industry-wide. So this has been a positive trend here, one of the positive trends for New Holdings. Another intentional decision by New Holdings, they slowed the pace of eligibility expansion for their credit card and lending products to more closely monitor performance over the coming quarters. The focus is on gathering additional data to ensure the credit models remain resilient. And I think this is a prudent decision from management. They felt unsure about the performance of their credit portfolio, and rather than continue to make loans without discipline, rather than continue to offer credit without discipline, they said, let's be more prudent with our lending. Let's gather more data. And then if we get more data that shows our models are performing like we expected or better than we expected, then we can expand our credit terms. If not, then we'll continue to remain prudent. And I think that's a solid decision, especially when you're dealing with credit cards, because these are non-recourse, right? If someone defaults on their credit card, there isn't anything New Holdings can do to recoup that money. There is no collateral. There's usually no collateral in these lending products. So I think this is a prudent decision. So New Holdings now is trading at a forward price to earnings of 24.8, near the highest it's traded for all year long. So while the business has improved throughout 2024, adding millions of customers, increasing profitability, increasing revenue, etc., controlling costs, the valuation has also increased. So they're kind of offsetting each other. I still like New Holdings stock. So to answer the question, do I still think it's a buy? Yes, I'm reiterating that borderline buy recommendation. I like the company just as much as I did a month ago, the difference being, or 2 months ago, the difference being that the valuation has increased and the business performance has increased. So they both ratcheted up, and there hasn't been a offsetting factor where, let's say, the company's performance improved, but the stock price remained the same. If that happened, I would have liked the stock even more. But the price went up along with the better performance. So we still like the stock, but just at these levels here. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.